from the Fed, and the Fed ultimately delivered them their dovish dreams in September, only to come back to an economy that was already improving. Of course, the markets then thought, well, that's too dovish. We're back there again, and the upshot here being below zero is that the path of U.S. economic data outcomes relative to forecasts now favors disappointment, is trending toward disappointment. To put this in other terms and make it a little bit simpler perhaps to digest, the market is very clearly being met with economic data that is softer than benchmark expectations. So economists' models are, first, set up rosier than reality is endorsing, and two, are not adequately adjusting to the new reality yet. In other words, as data continues to disappoint and as the quotient by which it's disappointing is growing, it's becoming increasingly clear that the economy is on the move, but analysts' models are not being tuned to capture it yet, which of course sets up a situation where the jobs data has a path of least resistance toward missing expectations. Now, that would come at a most inconvenient time for markets because, of course, they have been gripped by recession fears ever since we got the February set of S&P Global PMI numbers back on February the 21st. Now, those numbers have been revised a little bit since, and we'll notice here that we're not quite at standstill for the composite index. The prior forecast was just a hair above 50. The revision that we got this week, as we always do, for these numbers, about a week and a half after they're initially released, gave us slightly faster growth. The service sector, which initially looked like it had contracted for the first time in 25 months, looks like it did grow a little bit after all. But the upshot from these numbers and the recession risk contained therein, that has not changed. This is still the weakest economic growth that the U.S. has seen since December of 2023. It is still the weakest service sector growth that the U.S. has seen since that same period, November 2023. So we're looking at a situation then where the degree of drop-off is perhaps not quite as bad as initially thought, but the direction of travel is unmistakable. And it is, most worryingly, the service sector, which has been the overwhelming driver of demand, that is doing the unraveling. It's tempting, of course, to say that, oh, well, the issue here is tariffs, and once the tariffs represent a one-time adjustment in the price, whatever the final version of these tariffs is going to look like, then we will have a settling of the situation. And indeed, as we can see from looking at the red line here, manufacturing seems to have picked up, but of course, seems to have picked up for the wrong reasons. Now, when we look at what is actually being interpreted here by S&P, we find that the problem in the service sector is uncertainty. It is, in fact, that we don't know what policy is going to look like and that it seems to be changing as quickly as it is. Businesses are retrenching. Sentiment is down because they don't know what to make of what lies ahead, don't have the certainty to make spending and investment plans. Whereas the pickup in manufacturing is being seen as a front-running of the tariffs. That is to say, companies are trying to buy everything they can before the places from which they source are tariffed. So once that sort of a process runs its course, we, of course, end up with only a temporary boost that unravels. So the lay of the land, not especially encouraging, and lest we get confused and think this is just one data point, here is an aggregator. This is the Atlanta Fed's GDP Now tracker, and While it's probably not a good idea to get stuck on aggregate levels, we can see here that the economy is on track to shrink between 2 and 3% annualized in the first quarter. That's probably aggressive. But the direction of travel is unmistakable. This is a nowcast, which means that it takes in all the incoming economic data and then scales through its GDP model what those outcomes mean. That the green line you see here is falling off a cliff, to use a technical term, tells you that the tone of the incoming data has been overwhelmingly negative, which is why the model is reacting the way that it's reacting. So it isn't surprising then that the markets are concerned about global recession. Why global and not just a U.S. recession? Well, to quickly remind ourselves, the U.S. is the largest component of global GDP, and the overall pie is really only driven by three major engines: the U.S., the Eurozone, and China, making up 58% of global demand. The remaining 42% is mainly made up of vendor economies that serve demand in the growth engines and need to be exporting there in order to generate positive GDP contributions to the global pie of their own. So, of course, when we think about the US, we think about Mexico and Canada. Think Central Europe or Nordic Europe with the Eurozone. Think commodity producers from Latin America to Africa to Australia for China. And so you're looking at a situation then where over the course really of the past half year plus, so from about the middle of last year, the U.S. was the only game in town in the realm of growth. China was slowing and has now seemingly stuck into a kind of uneasy sort of sideways drift. Europe was slowing and is now barely growing at all. It's essentially at standstill. Of course, we, as a consequence of all the news flow this week, now have vast expectations for a pickup in economic growth in Europe around a defense buildup. And China is meeting for its National People's Congress this week. And as expected, they picked up their deficit objective, which means they're perhaps girding up for a little bit more fiscal stimulus. But none of those things have yet to materialize, and none of them are actually doing anything for growth today. Instead, these numbers remain relatively anemic. Meanwhile, the U.S. has tumbled from its perch just at the end of last year, where this was January, this is February, and what we've done is, instead of seeing China and the Eurozone converge on U.S. strength, we have seen the U.S. converge on their weakness. Of course, we've just received the February update for the global PMI numbers, and as a consequence, when we have this kind of a situation where two of the three engines of global demand aren't working, and the third is rapidly coming apart, the whole global pie is following suit. And you can see here the composite index is, at this point, as of February, down to the lowest levels we've seen since early last year, late 2023. So, needless to say, the markets are not off sides to be concerned about a global economic downturn and perhaps recession. Not surprisingly, what this has also done is it's powered a dovish shift in Fed policy expectations. And this really speaks to the other big event risk that the markets face tomorrow. After the jobs data, we are going to get a policy speech from Federal Reserve Chair Jerome Powell. He's going to issue one of these speaking opportunities to assess the economic outlook. This is not going to be obviously a policy announcement speech. That'll have to wait for later in the month, but we will get the clearest indication that we've seen in weeks as to what the Fed thinks of all of this. We know where the markets think. They've clearly adjusted in a very dovish way. You can see here the cumulative rate cut tally now versus even just a month ago has been dramatically changed. In fact, now the market's anticipating 93 basis points in rate cuts this year and next. They were at close to 42 or 45 just 3 weeks ago. And so we have a situation here where the markets have clearly extrapolated an economic downturn and extrapolated some sort of growth risk to the tune of at least one, probably more rate cuts than they were expecting even just recently over the forecast window. Moreover, there's a sense of urgency in what the markets are saying. We can see for this year alone, 72 basis points are on the menu. That's only 3 basis points shy of baking in fully 3 rate cuts at 25 basis points apiece. The outlook for next year, again, only 3 basis points shy of 1 cut. That's how we get to 93. Now, the tally total lines up fairly closely with what the Fed itself anticipated back in December. We can see the adjustment here was from an outlook calling for 3.4 as the rate for 2025 in September to 3.9. From 4.4 to 3.9, that's 50 basis points. From 3.9 then into 2026 to 3.4, that's another 50 basis points. So there's 100 basis points in cuts here that the Fed envisioned in December between this year and next, which is very similar to the 93 basis points that the markets now have in their outlook. And so seemingly there is alignment, but the markets are wanting that stimulus to come faster. They want 3 cuts this year, 1 cut next year, not this more leisurely spacing out 50 and 50. Now, this, of course, represents a challenge for Fed Chair Powell. He can't exactly ignore what he is seeing, stock markets falling, growth expectations unraveling, rate cut expectations building. He, of course, has to acknowledge that this is occurring. But what he does next with that information, that will be very interesting indeed. Now, he may decide that now is the time to dial up dovish intent. Say, you know what, if the economy is coming off a cliff, we are going to react. We see the data that's been coming. We note that it's having the effect that it's having, and we are going to stand in front of this train and use our policy muscle to help get things back in the right direction. Of course, that's exactly what markets want to hear. It would also be a dramatic U-turn, considering that for the past several months, the Fed has said nothing, but they are in an incremental adjustment stage. They are very close to getting inflation to be trending on target to 2%. They want to make sure they narrowly do that without hurting the labor market. Their objectives are in balance. Their preference is to wait and see and not to make rash or radical changes, and also not to overinterpret data flow. Now, one might say they are supported in having a little bit of a more dovish perspective, and that Chair Powell might reflect that, considering inflation expectations have started to tick down against the backdrop of all of this consternation in the markets. So as yields have come down and as the dollar has come down with them, we can see that inflation expectations have ticked down as well. This, of course, reflects downturns in economic growth expectations. So the Fed would be on reasonably solid footing to say, well, the markets are envisioning some sort of economic weakness that we are going to push back against. That could give Chair Powell some room to get a little bit more dovish. But at the same time, the ISM PMI surveys that we got this week from the Institute of Supply Management, they tell us that with all of this consternation and uncertainty around tariffs, costs are rising. And so the price indexes for services and for manufacturing, especially where that sensitivity to tariffs is greatest, that is surging. So the Fed is not exactly in a position to say that it can confidently conclude inflation is a objective that's met. It's an afterthought at this point, and we have to go the other way and focus exclusively on growth. Here come rate cuts. That is probably something that would look too erratic and spook the markets more than help them. And besides, the trends in price growth don't seem to support it, which sets the stage for a speech from Chair Powell that perhaps acknowledges what's going on, but keeps an even keel and maintains an incrementalist perspective and says, well, we are, of course, going to react if things get scary, but we're not going to overinterpret this data. For now, as they've been saying, we are going to walk this slowly. We'll see you for the policy announcement later this month. That could be a better venue, perhaps, and some stage setting for that might happen here with a bit of dovishness, but a full-throated and a dramatic pivot, that's probably unlikely. And with that, we end up with a bit of a toxic mix. If jobs data is going to surprise to the downside of these expectations, and Chair Powell is not going to endorse this sort of readjusting with a headlong dive to the dovish side of the policy spectrum, the markets are going to probably reason as follows. The economy is slowing. The risk is rising. The Fed is not going to act with urgency, at least for now. So that probably means stocks have more room to go down. The help is not coming imminently and not in a hurry. So bond yields downwind at the longer end of the curve probably have room to come in further, and bond prices have probably some room to come up. And because the Fed is going to have to then play catch up on easing into an economic downturn, the pace of easing will probably have to be more dramatic later. We saw that same story play out last year when the Fed was frustrated with the Fed's inaction, as we discussed earlier, mid-year, and started to rapidly bake out more easing because they felt the Fed was dragging their heels. That's probably not good news for the U.S. dollar, as yield differentials turn increasingly against it. Of course, it doesn't help at all that the policy calculus, let's say for Europe, is changing to a more hawkish perspective as markets eye what the defense build-out now envisioned there would mean for inflation and growth. But just from the dollar's side alone, weakness in the economic data, in this case, very important economic data like the jobs report, coupled with a Fed that doesn't seem to be running out the door to do anything about it, that probably means sentiment doesn't get much of a lift, while rate cut expectations get another big bump out along the horizon. That probably helps bonds. It probably hurts dollars. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am back with Chris for Futures Power Hour Mondays and Fridays, so I'll be there tomorrow talking about what this jobs data has wrought. I'm likewise on with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
Zach, South Carolina, how are you, my friend?
Hey, I'm good, guys. I just wanted to let you guys know and Tasty Nation know that I've been following you guys for 3 years. Where else can you call 2 real traders? They pick up the phone and answer your question. There's so many so-called traders out there that give you vague strategies and want you to buy their course to learn more, but you guys at Tasty put all your info out for free, and all you ask in return is for us to use your platform. Thanks as always for what you guys do.
Love it, man. Thanks. Thank you, man. Thank you. I really appreciate it. Very kind word.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a tastytrade account. Plus, smart tech and a broker who's got your back at tastytrade. Make your move, genius. tastytrade.
Welcome in Tasty CEO Tom Sosnoff, also founded Thinkorswim. Some call him the godfather of retail options trading. Tom, it's good to have you on. How would you be reacting as a startup founder to this news?
I'd be really pissed.
Yeah. As you should be, by the way. I'm glad you said it because I can't.
And this is how we think as traders. You're much better off, instead of trying to follow the trend or follow the fundamentals, you're much better off playing the role of a contrarian.
And what I really want to do today is kind of break it out of that box and make it what it really should be, which is about understanding and thinking about probabilistic, predictable outcomes, about quantitative strategies. True financial literacy is about taking risk.
There's a very thin line between opportunity and risk, but where there's the most noise, there's the most opportunity.
The second you believe that somebody knows something and it's not you, then you're dead.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
What is going on, everybody, and welcome back to today's segment. We got one more day under our belt, another sell-off. Gus, something is different. Good to see you, my friend. I just don't know what it is. But how are we doing today? We survived.
Yeah, survived. Survived was the word I would use. It was another bloody day. Lots of sell-off. I'm very long delta, as I mentioned last Tuesday, and fortunately, all of my positions are long-term enough that I have no real concerns yet. But the portfolio is hurting. So yeah, hurting on that front. But yeah, good day overall. Bad hair day. I think that's what's different. I'm flat.
I'm actually rocking with it. I don't know. I'm flat. I don't know. I don't know what it is, but I'm rocking with it. I don't know. I can't put my finger on it. I'm definitely rocking.
Some asymmetry happening.
Some asymmetry. Yeah. No, I hear you. I mean, on my end, been pretty beat down in terms of the portfolio. Well, we'll look at that. I got a couple positions on that expire tomorrow. at close. So we had some weeklies on, and then I have a longer dated position as well. When you said longer term, were you talking around that 45 days to expiration, or you have some past that too?
I have most are past that. In fact, I think my tightest position in terms of time right now is this NVIDIA vertical, which is 42 DTE. Outside of that, I'm pretty sure everything is north of 60.
I got you. That's not too bad.
Yeah,
you got some good time.
I got lots over 100 too. The longest of the bunch.
You got a lot of.
What's up?
Are those longer dated ones long delta?
Yes.
Oh, nice. Oh,
yeah.
You got it.
Yeah, just playing for the eventual recovery. I said on Tuesday when I entered all these positions, I'm not really trying to time this up too much. I do have time constraints, but I didn't was not confident that we were at the bottom even after a little bit of recovery yesterday.
Yeah.
I will say I did kind of feel like a genius yesterday, but we pulled back again. But yeah, no big deal. Like I said, I'm hurting, but as I say often, it's not a loss until you sell. I'm down, but I'm not lost.
Technically buy back.
That's where we're
technically buying it back. Yeah.
Data trader Bob Sala, what's going on over in the chat? Bob, haven't seen you in a while. Good to see you, guys.
How we doing? No, yeah, we put on some positions on QQQ. Been looking at, I have something on Meta too, so we'll take a look at those. But you kind of mentioned it, timing this bounce. We all kind of know and suspect, like if we got a bounce today or yesterday or tomorrow, next week, it's not going to really be a surprise per se to anybody, just based off of how much we fell and how quick we fell. But yeah, timing, it's going to be that difficult part because a couple of the positions that I do have on right now are long delta, but they expire tomorrow after the bell. So we need the market to move. And this is what we got on right here, Gus. We got Meta. We have 3 QQQ positions on, and really we're pretty much at the bottom on this one. So any type of bounce would be really nice. We got a ways to go on some of these. So if tomorrow's the day, it would be nice, but we also have some 42 days till expiration on too. So there's one of those that, don't have to time as much, maybe just catch it within that window. But that's what we're looking at right now. And then Meta, this one was up pretty decent yesterday. Pretty surprising. We took out yesterday's lows today too. So just that selling continuing to the downside, but I'm going to use it as an opportunity, maybe sell some premium in some other big names, maybe some other blue chips. But that's what we got going on, Gus. The move in Meta was pretty big too. And VIX is still expanding. So I'm not complaining on that front.
Yeah, that's what I was about to mention. VIX closed just below 25, was hanging over 25 for a good part of the day today. Wish I was still long. That's a rare position that I wish I could have left open longer. It expired. Sometimes you wish there was more than max profit to be had, and all you can get is your max profit. But the contrary to that is some of those trades go to the max loss, and I never wish my losses could get bigger. So it's, that's the trade-off when you do defined risk anything. But yeah, really been kicking myself, especially with all this long delta that I have, and especially knowing that I've been expressing the sentiment that, this might not be the bottom, and I'm not trying to be too careful with timing. I don't know why I didn't do the same thing that I did last week and just get long VIX and get long SH and, have some little hedges in here that could maybe help me out in the micro. So yeah, just full pain today. I only have 2 trades that closed the day green of what's this, 12 total. My Berkshire Hathaway closed a whopping $3.80 green, millionaire over here. And then I also have shares of CCK, which did close the day green. So shout out to CCK, living against the dying market.
So what are you selling there? You sold about a put spread?
No, that's just shares. I have 25 shares. So
nice.
Yeah, that's a tail in Congress move there. But yeah, all in all, still feeling confident, even as long delta as I am. Portfolio beta adjusted delta is 58 right now, which is a bit steep. Right. But my theta is only 18 because most of these things are incredibly far out, and so we're just gonna weather the storm and hope that it doesn't sink the ship. That's where I'm at.
I like it too, because you have a pretty good amount of long delta, but you have a lot of time on those too. So if we get that pop in those underlyings and then volatility should come in a little bit too, we should see a little bit of a contraction. That'll be nice. You'll probably see that across the board on all your positions. So I'm looking forward to that for you. On my end, couple weeklies, and then Meta and QQQ. So we'll keep an eye on that for the most part. I think I'm comfortable with the Meta position, comfortable with QQQ, and even to say, got a lot of long deltas on. But tomorrow when the market opens up, especially if we somehow end up lower tomorrow, I'm probably more so going to get more, long delta on, maybe 45 days till expiration, maybe out in the April expiration, but definitely sell some more things to the upside. So we'll see what we get. But that's been top of mind.
And I think that we're going to have, should this downtrend continue, I think that there will be plenty of scattered days like yesterday where we get, little green recovery days, and perhaps, some long delta, and continuing to take on some long delta can lead to some profitable trades even in the short term, and act as somewhat of a hedge and profit collection against all of this negative movement. But yeah, it's we're getting towards blood in the streets territory here. It's getting to be pretty crazy.
No, I mean we are, especially if you're a Tesla lover, because Tesla has been absolutely beaten down. Granted, Tesla went on an absolute face ripper run since the beginning of November, and then topped out around December, about mid-December. And then we're coming back down to these November levels. So it feels like, Tesla's really been taking a beating. But if you would have just rewinded about 4 or 5 months from now, we're sitting at about the same levels. So I know this one's on your no trade list, so I don't want to bring up any trauma or PTSD.
Yeah,
Gus, but
the Trump bump, they're calling it with Tesla. I've seen that.
The Trump bump.
The Trump bump for
That's
Tesla.
Funny.
It has officially ended. Yeah, as you said, we were pretty.
Wait, what is that referring to? The Trump bump, as in like the rally we saw in Tesla, or what?
That was the bump, and now it's given it all back. But yeah, Elon being as close to Trump as he was, and all this involvement in government and everything, post-election saw a huge run up. That's the November onwards, pretty much vertical there.
Yeah.
The Trump bump. Everybody add that to your vocabulary.
Yeah, no, that's steep. Even on this way down, there really wasn't too many opportunities to get short. Even these relief rallies on Tesla are very short-lived. And then that aggression to the downside is pretty aggressive. This is a pretty big sell-off in Tesla. So we'll see what we get there. I am still interested in Tesla. If Tesla gaps up somehow, or there's some type of rally on Tesla, maybe we'll look to sell some call spreads on there. That would be nice. Maybe get some more short delta in the portfolio. Because everything else is long. But that's what I've been looking at over there. Speaking of Tesla, Rivian, those have been getting a lot more popular. I think I see those almost once a day now, almost outside my building at least. But are you a Rivian guy, or you kind of don't care too much about this EV?
I certainly think that it has a place. I don't know if I've said it on this stream before, or if I'm conflating with Bad Trader or whatever, but no, Rivian is interesting because I think that Tesla is trying to position themselves to be the Ford of electric vehicles, the very common, everyday, affordable electric vehicle. And as such, that clears out the luxury EV space that they used to occupy. And I think Rivian is right here waiting to fill that gap. So I am high on Rivian in the long term. I don't know if I'm a buyer just yet. Their numbers are still pretty bad. But holistically, I do think that we're going to see, as you said, a great increase of Rivians out on the road, and I think that their sales numbers are going to continue to increase. And this is something that I am eyeing for a buy, perhaps as early as later this year. But
yeah, Rivian specifically.
What Rivian? Yes. Not a Rivian vehicle. I am priced out. I am priced out of a Rivian vehicle. I'll let you guys know if all this if we get a huge pop in the coming weeks.
I heard they're expensive. I hear Rivians are pretty expensive. I hear most, especially more on the luxury end, EVs are typically pretty high priced right now, relative to the other models. But what's going on, Lone? Hope you're doing well. Good to see you in here.
Yeah.
Nicola,
if you want a new one, it's 70s is pretty much where they start. 69.9 for the SUV. The truck is a little bit cheaper, but yeah, it's definitely a considerably higher price point than what you're talking about with Tesla.
Yeah, and I was just thinking, with the tariffs with Canada and things like that. I know we get some automotive pieces from Canada too. I'm curious to see how that's going to affect the EV industry. I was thinking about the other day. I was like, I wonder if this is going to make for a bigger push for EV vehicles, or what any of that might look like. I had on my mind as well. It says Tesla has to deliver robo-taxis. FSD or the stock will be back to $100. Robo-taxis, we talked about that the other day, I believe.
I don't know that we did.
Maybe not.
Yeah, we. I know Scott was just in one. We got some funny footage.
Maybe
for
that's
socials.
Yeah, Scott was the one. Maybe that's what my memory was recalling. But I don't know. I don't know how I feel about the robo taxis. I can definitely see them coming to fruition. I can see that industry really taking off, but I think it might take a little time.
Yeah, I agree. I don't know. I don't know that it's an immediate fix. However, in the case of Tesla specifically, they have been overpromising and under delivering on that front for some time. So I agree that some type of. I mean, they need some kind of major news if we're going to stop this bleeding. But I don't know. The other side of the coin for Tesla is that they got the Trump bump, and then it's ran down with the rest of the market a bit more pronounced than the rest of the market. But as you said, all we are is just back to pre-election highs. So the way I see it, the market priced in Elon getting incredibly favorable treatment and Tesla getting incredibly favorable treatment from the federal government. Because that hasn't happened yet, we have priced that back out. But all that's happened is we've returned to the pre-election levels. So yeah, I don't think that the sky is falling for Tesla, but it certainly is a bad look.
Yeah, no, not a great look, but these calls on Tesla aren't looking too bad. I haven't gone $10 wide too often, but this is what I'm going to be looking at because I mean we're sitting at a 70% pop. This is selling some calls on Tesla. We're about 42 days out to expiration, $700 worth of buying power. So I mean we're collecting a little under a third of the width on these since it's a $10 wide. I think a third would maybe be 3, 3, 3, 3, 3, 3, 3, 3, 3. 3, and then but if we do get a pop in Tesla, I think this is something I'm going to be looking at. Again, I need more short delta ons. If I can find some underlyings, and I don't know what else you've been looking at, Gus, but if we can find some underlyings to put some short delta on that we're comfortable with, I'm going to take a look at it.
Man, I wish I had more ideas for short delta. I would have been way more profitable over the last couple of weeks. Yeah, I don't.
You're telling me. Telling me. I've been getting hammered the last week, bro.
Yeah. No. Yeah. It's
this
been
market.
bad.
This market's been killing. Yeah. So
I'll tell you what though, Broadcom is up considerably after their earnings today. Perhaps that will trickle over into some chip stocks a little bit and help market make. Not entirely sure, but if there's some residual to Nvidia, then all of a sudden there's some residual to the TSMs and SMCIs and AMDs and AMATs of the world. You know, perhaps things can start to turn over a little bit. Nvidia is dying today.
Yeah.
I can tell you that for sure. I'm long on Nvidia. That is my
What are you doing over there?
Worst position of the day, in fact. That's when I tailed Tuesday's cherry picks on that one. I have 42 DTE. April 17th is the expiration. I sold the 100 and I bought the 90 puts. So short put vertical to the upside. And we're still well above the 100. I'm not super concerned about it, but if we have a few more days like today, all of a sudden I will be.
No, I hear you. This is a lot of velocity to the downside on this one. Just looking at things like this, I have such a difficult time selling, selling short positions into the lows. If we get a pop on Nvidia, maybe that's something else I might look at too. So, I mean, I like that as well. AMD, I know you brought up a second ago. AMD, funny. AMD is so popular. We're so familiar with AMD. Little did I know. I mean, now just thinking back at looking at PC setups, all those kind of things, little did I know I was looking at a lot of AMD's products. But AMD's been getting absolutely killed. Decent IV rank. Earnings was not too long ago. Or we have earnings April 29th. Crazy they're coming back around so quickly again. But
AMD, I don't know. AMD is probably my still to this day my most traded stock straight up. The first 2 or 3 years of my trading, AMD was like my main. I averaged probably north of one AMD trade a day. I would just
really. Why the volatility, the liquidity? What was so attractive about it?
Yeah, 2020 to 2022, it was both. It was just high liquidity, really tight spreads, high volatility. It's a 1% intraday mover, and I was primarily a day trader at that time. I've shifted progressively more into swings, but. When I was day trading, AMD is the prime type of stock that you look for day trades. And I mean, it was a prominent thing. I mean, it was sit down in the morning, run the scanner, look at AMD, because I was always looking for the next angle.
It's like, what did you need the scanner for?
Yeah, exactly. The scanner was to figure out what all the backup stocks are if AMD isn't going to move today. But
that's funny.
Yeah, I was really high on AMD, and I was high on them as a company too. At that time, they were a really strong grower, consistently working up. That was also the time that I built my PC, and I chose to put a Ryzen 7 in that thing. But it's just.
Oh, how was that?
Oh, I love it. I love it. It's been great. It keeps on chugging. Had to replace the thermal paste one time. It's been 5 years. I think I should replace it more often than that, but that's all I've had to do. So yeah, no complaints on the Ryzen 7, but it's just, yeah, I mean, they've become little brother. Quite frankly, they've become little brother to NVIDIA. Nobody's really talking about AMD anymore. And it's a real shame. But I don't think that they're dying. I just think that we have to reach whatever price is going to be the bottom before they can start slowly working back up again. But we haven't found it yet.
That's a nice way to put it. JP Morgan, Goldman Sachs, Lobo is looking at, we'll check that out, some of the financials. Iron Condors and AMD, is that what you did today, Bob? AMD detoxification. That is exactly what you needed, Gus, to detox. Let those receptors heal itself.
It's true. It has been like a detox all this time. And I'll tell you what, whenever it starts moving up again, I'm happy to start trading it again. It's just the volatility and the liquidity also shifted to NVIDIA as well. But at the same time, NVIDIA has the Tesla problem. So I've just kind of
I don't know. AMD sounds like the gateway to trading VIX. I mean, that's got to be a product that's a little more volatile. That's the gateway. No, looking at some of these financials, though, JP Morgan's been absolutely beat down. And I'm going to assume that's going to be very similar with the other financials like Goldman Sachs, Bank of America. I know we were just looking at Wells Fargo, which is WFC. Haven't traded any of the financials lately either. Earnings coming in April time. AMD Iron Condor was one of the trades from the research team this morning. No, AMD is going to be on the radar for me tomorrow, at least. AMD or NVIDIA. I probably won't go with both, but I'll definitely choose one or the other.
Yeah, as far as financials, I do have a Goldman position that has been killing me. I've had it open for some weeks. Just shares, but
that was a gold.
Yeah, GS, like Goldman Sachs.
Oh, Sachs.
My apologies. My apologies to Mr. Sachs. But yeah, I've had just 2 shares chugging on this for a little while. I bought it in this chart here at the middle of the drop. There was a whole situation where I don't even remember exactly my sentiment anymore. JPM, somebody got a lawsuit. Morgan Stanley got a lawsuit. Goldman Sachs moved down on the sentiment, and I was like, oh, Goldman will recover quicker. That sentiment still holds, and it is just shares, so I'm really not tweaking at all. But it's just another thing hurting me right now in the midst of this fall off. So yeah, but that's been my sentiment on financials, and I'm down $50 on these 2 shares today somehow. So really bad day for Goldman Sachs today. That's for sure.
No doubt. I mean, the bad day is really helping that volatility out because, I mean, over here, I'm almost near the expected move on the put side, and I have a 72% pop, and I'm collecting over a third of the width of the strikes, and I'm pretty far away from the strike price right now. So seeing that increase in volatility is nice to see, something we really have not seen over the last couple months. I mean, this is the first time I think VIX was trading over 25 this year alone. So I hope those shares do come back. But at the same time, I mean, we're definitely seeing that premium increasing across the board, and you definitely see it in some of these financials. I did not take too good of a look at Goldman Sachs, but this one looks really good. I mean, in comparison to JP Morgan. But enough of the financials. 0 DTEs coming next week, Gus. How are we feeling about that?
Man.
0 DTEs. He said, I'm not going back.
I don't know. I don't know. I mean, I suppose like anything else, it's just so much risk and so much reward. I like the occasional 0 DTE Iron Condor. I'll place that 31 or 32 minutes before market
selling
close.
That?
Yeah, sell that. Yeah. Collect the premium on low volatility days. But that's a strategy I haven't gotten to implement very much in the last month or so, as volatility has continued to spike, because I don't have the confidence that major ETFs aren't going to move 1% in 30 minutes before close. It's been a bit tricky. I don't know. I will probably abstain from 0 DTEs myself. But I encourage anybody who has a bit of a propensity for risk to go out there and get after it. 0 DTE is incredibly profitable. We have so many people here in the office and at home who trade them profitably on a daily basis. But it's just, scary for me.
No, I hear you. They're extremely volatile. I mean, I guess that also depends what you're doing with them. But I'm just going to look at, especially with coming up on next week, excuse me, especially coming up on next week, something that's been really helpful. I think we talked about this one time. But like, for example, going back to seeing the fluctuation of those option contracts themselves. So if we go over here, let's say we're looking at the 598 puts. That's kind of the high that we rallied up to today. 598. We can right click between the bid and the ask. And if you right click between the bid and the ask, it'll pop up, it'll say view option and chart. And then you can see the price fluctuations of the option contracts themselves. I thought that was something that was pretty cool, but has been helpful, especially in shorter termed option contracts. It also just helps with the visualization of how your options are moving in value. But that's something that's kind of neat.
Well, yeah, I think this is also
these options absolutely exploded.
I think this is also a great visual tool to see, how liquid the options are. All these gaps, if you look a little bit further back in the chart, when these contracts are further from expiration, it's gap after gap. It looks ugly. It looks like, I don't know, your local utility company, if they're publicly traded, their chart probably looks about that way. But then, as we get closer to, expiration, all of a sudden there's progressively less and less gaps. Hasn't been one in the past few days. It is. I think this is a great visual tool and a little mental exercise as well.
No, yeah, definitely. It is crazy though, just to your point, how volatile these contracts can be. I mean, these ones were trading at about at around the consolidation highs today. I mean, these contracts were trading at around 315. By close, they're closing at around 883. That's a massive move in a very short amount of time. So just thinking about, you're buying that, you're selling that, the volatility that comes along with it. So keep that in mind.
Yeah, absolutely.
That is going to do it. I think on the watch list for tomorrow, we'll have Tesla. If we see some type of pop in Tesla, obviously QQQ. We need a rally in QQQ. I have 2 positions on that expire tomorrow after the bell. So we'll come back around to that, see how that did, and we'll talk about it when we're on again. But other than that, anything else on top of mind before we start to wrap here, Gus?
Yeah, I don't, nothing concrete on the watch list tomorrow, but I am interested to see whether Broadcom's earnings beat and subsequent gap up, or Costco's earnings miss and, I assume soon to come, subsequent gap down is going to have more of an impact on the market. Had both of those gone green, I would be feeling very bullish about tomorrow. But that is a shocking miss out of Costco. That's one of the bigger earnings calls this week. So not entirely sure. It may just be more of the same. We needed Costco to save us. Powell speaks tomorrow as well, so perhaps he will say the market is oversold. Everybody should buy, and we will get
another leg
$40 vertical candle.
Yeah. We might exactly get that. We joke about it, but getting another leg down tomorrow, though, in all seriousness, would be pretty crazy. But anyways, I saw to put in MES 71 days a couple weeks ago, thinking I was staying small. Volatility makes it grow teeth quickly. And I know we've mentioned before how a lot of correlations shift to one, especially whenever we're getting such a market sell-off. That's what it kind of feels like. It feels like a lot of the assets are becoming a little bit more correlated that are in different sectors that we've seen over the last couple days. Eating homemade carnitas tacos while waiting for Victor. That sounds like a move. That sounds like a vibe. Some carnitas. I'm more of a steak taco, but I can do that too.
Hey, carnitas will go. Been getting into El Pastor a little bit recently. That's a new one for me.
I always see that at Chipotle. Have you ever had it from there?
I haven't had it from Chipotle. I don't get to Chipotle.
I probably want to try it.
Chipotle, man, the inconsistencies, they bother me. I know I'm just the average consumer on that, but I watched the guy who went every day and weighed it and did the whole study, and it's like, man, this is kind of messed up.
Wait, what was the study about? Do I want to know that as somebody that likes to eat there?
Yeah, there was a guy who for 365 days he got either a burrito or a bowl every day with identical ingredients in each, and he split it like perfectly 50-50, and then he weighed them every single time. It was like an insane amount of variance. I think that the lightest one was like 3 times lighter than the heaviest one, and that's too much. And literally, all you got to do is make a standardized scoop, guys. What are we doing? Just give them a metric cup or something to make this a bit more standard, and it would fix it. I don't know why they won't.
No, that's why you got to become cool with people that work at Chipotle. I'm cool with everybody. I walk in, I'm like, yo. what's going on with the guac, guys.
It's true. It's true. Yeah. No, I'm always very, very pleasant, and I won't pull out the whole trick that I'm sure they're so tired of, where you ask for one portion and then after they serve it, you ask for the second. You're like, oh, I meant double steak, so that they don't establish a smaller first portion. I don't play that because like they're privy to it. You know how annoyed they are. Also, yeah, I think that when you ask for a one portion, you probably get like a 1.25. And I don't think they're going to give you 2.5. I think you're just going to be disappointed with your second scoop. That's my opinion.
That's the valid take. Chipotle for the win, though. CMG, that's an expensive stock. We'll see if they ever do a stock split. But on that note, Gus, anything else, brother, before we head out?
Nope, long overdue for the split on Chipotle. That would be my closing comment. I can't believe they haven't done it yet.
We'll see what we get tomorrow. Always great seeing you guys hanging out with Gus and I. We'll come back around to tomorrow with Jerome Powell. And see how the market closes up on this sell-off week. And that's going to do it. Stay tuned for Victor Jones coming on next, and we'll catch you guys next time. Peace.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top yearly recap.
Breaking news on Instagram. The first segment of your line dancing has been posted. Left together, switch, turn. Right together, twirl, turn. Hip, hip, hip.
Right together, spin, clap. Left together, spin, clap. Hitch, 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 turn, shuffle, rock, shuffle, rock, shimmies, shimmy.
I took 5 lessons for Casey's wedding, and all I knew how to do was
right, together, spin it around. Yup. And you want to clap. And then like strut down, strut down, strut down, strut down. Right together, spin. Left together, spin. Hitch, 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 cross, turn, shuffle, lead, shuffle, rock, shimmy, lasso.
This is not good.
Hey!
Oh, he's got the walk down. He's got it down.
Perfect, and you got the band. You got everything.
That is not even close.
Drop, bitch, stole my. Oh, it's flawless.
Look, it's beautiful.
Flawless.
No.
You're walking way too fast.
And go stick your finger in all of our lunches.
Now complain about something.
Oh, God.
You watched the debate, you knew who won, and you just didn't want to admit it.
I was in New York. I was flying home that night, and I'm so sorry that I didn't go back and tape the vice presidential debate.
First of all, I think it's hilarious that you run a technology company and you still think you think you had to tape it in order to watch it. You think you have to tape it?
He didn't have a blank VHS tape to spare for the debate. Stas, what comes up next? The opening bell. Don't look so surprised. Sadlov has been this way since 1980 when you first started trading. Wait a minute, was it always 8:30? Yes, the opening always was the same. The closing has changed.
Like, what has changed? I don't think so. Nothing's changed. The only thing they did, I think, was add the 15 minutes.
Excuse me?
The only thing I ever think that changed was the 15-minute curb session.
From 3 to 3:15, so they did change it. So it was the closing and not the opening that's changed.
For option traders, the 15 minutes.
Well, listen. We're not bean traders here.
Do not engage.
Wait a minute. So
when I got in this business,
we used to open it. We used to open at 9 o'clock. Since 1980 to now, we didn't always open at 8:30 in the morning.
Yes, we did. Is that a $20?
I am going to get this $20 off of you.
I don't think so.
No matter what. Chris, how are you, my friend? Chris, your job after you get off the show here is to find out when the New York Stock Exchange opened in the 1980s, what time they rang the bell. I have a $20 bet with Sosnoff. We're going to be eating good tonight. I already decided that Sosnoff will be having cereal for dinner tonight. I said the New York Stock Exchange did not open at 8:30 Central Standard Time. It opened at a different time. Soz said it always opened at 8:30.
I already have the answer. You guys need to choose a year, and that will determine which one of you is correct.
No. I've already won this. I said from 1980 to now, 2024, we didn't always open at 8:30.
I gave him 1980, but I technically didn't start probably till 81. But go ahead. What is it?
September 1985 is when it switched to 9:30 a.m. Eastern.
Thank you very much. Thank you very, very much.
Not 1980. Not 1980.
I remember. I was on the floor. I was working because I would have to get up earlier in the morning.
In 1980, the New York Stock Exchange opened up at 10 a.m. Eastern. It closed at 3:30 p.m. Eastern Time. The schedule was in place until September 1985, when the opening time was changed to 9:30 a.m. Eastern.
Pay me,
Get the full scoop by checking out the archives at tastylive.com.
Oh, yeah. It is Thursday, March 6th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. Good God, are they throwing a lot of incentives at you to chew on? But no fear, people. We are here. Hopefully we're giving you a little bit of a value add. Shout out to everybody watching on tastylive.com. What a horrible marketing intro. Hopefully we're giving you a little bit of value add. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile application. But if you want to be part of Bing, this chat box on your screen, did we do it? Did we time it up? We never get it. If you want to be part, there we go. If you want to be part of that, chat box on your screen. There's only one place you can go, and that's on Tasty Live's YouTube. So head on over to the evil Google YouTube. Find the channel. Come on in here. Start slamming your skull or your metacarpals, your phalanges against the keyboard. Anything. Just type in random ass characters to spoof the Google algorithm into putting us in front of as many people as possible. Let's save or at least deprogram the world one view at a time. Shout out to everybody who is watching in the chat and everybody who comes here and spends a little bit of time with me at the close of their business day. I shall say what is up to all of you. Lone, what's going on? D-Chat, what's up? Sleepy Mocha Victoria, I see you. Theta Trader, Donna Ski, how are you? Brian Watson, the YouTube GOAT, how are you, my friend? The end is nigh, or until Powell speaks. Cato Prime, how are you? Brian McBroom. I think there's a bunch more in here. Eric Simmons. Oh, yeah, there's a bunch. Lobo does. All you guys. Sub-Zero, CM. CM, I got a bone to pick with you. I think somebody showed me a comment you made that said yesterday's show shows how realistic my political views are and something contradictory as well. I don't think they're unrealistic. I think it's hard to get the incentive structures, but not impossible that would create the outcomes I'm in favor of. And I don't think I'm contradictory, but tell me. Big words, my friend. You got to back them up with receipts. But shout out to everybody. What a day. Data Trader says, best Singapore-based English language streaming channel on YouTube. That was clever. All right, everybody, let's talk markets. I'm sure
Now, I'm sure we are going to climb into some weird territories today again, but let's start markets. 57, 67 on your screens. My friends, the S&P 500 cash was down 1.75% today. I said yesterday, the chances are we're flirting with that line in the sand that the next time we talk, the likelihood that we're talking on the other side of 5,800 was, I thought, likely. And here we are. Here we are, my friends. The NASDAQ down 2 4/5%. It's a pretty ugly day for the NASDAQ. Who would have thought? I swear, these people. Who would have thought that the most concentrated index at 7 companies making up 40% of a 100 stock index could be detrimental in the case of a risk-off sentiment in the marketplace? Who could have possibly imagined that? The Dow Jones down 1% and the Russell down 1 2/3%. Ugly day. The interesting thing about today is the relationships, because I do think when the market gets going in this direction, when you start to see correlations start to make their way towards one. There isn't a big spike in correlation here, but correlation are making their way towards one. When I look at the world, I tend to think through the lens of relationships. If we're either getting expensive and I don't want to time anything, or we're sort of in the midst of a sell-off, which we clearly are here, and I want to start getting long things, to me, the most interesting lens to view the world through is relationships, because it's going to get really hard to make calls on direction, right? As much as you like the risk and reward, you might like the risk and reward of, let's say, an upside stab at the market here. The slope of this sell-off is still ugly. You might like the price, but the slope is kind of nasty. And while you've got a little bit of VIX backwardation, I would argue it still doesn't quite look like we've got a washout. And so the relationships start to be interesting. And say what you will about the Russell NASDAQ spread, it hasn't been the greatest performer. The Russell's been kind of dog, what. It's been one of the weakest of all the 4 majors, but ultimately the Russell tends to be a bit of a canary in the coal mine. So you can make an argument that the Russell's doing exactly what it should do, which is a barometer for a little bit higher beta risk and sort of a barometer for what people are going to feel about the U.S. economy. I do think if you're getting to a point where you're starting to get closer to a place you want to take a stab, I think the relationship trades become a bit more interesting. Why? It's because it's going to be hard to pick a direction. Even on a dead cat bounce, maybe you get it right for 1 day or 2 days, but if we're still in the midst of a pretty decent sell-off, it's going to be hard to stay with conviction. So I think this idea of looking for one asset to outperform a second asset becomes more interesting, because regardless if markets recover, regardless if markets continue sort of their downside move, just betting that one outperforms the other can be a sort of a little bit of a shelter from the storm in picking direction in tough markets. I mean, think about this. Thursday, you get a nearly 100-point sell-off last Thursday. Friday, you get a nearly 100-point recovery. Monday, you get a 120-point sell-off. I mean, that's the type of market that you're in. And if you're a vol seller and you're just taking what the market can give you, you're doing the exact opposite, well, then you're probably having a decent couple of days, decent couple of weeks, even though, probably carrying some downside deltas is probably helping. But, I don't know that that's everybody out there. And so one of the things that I look towards in markets like this, just putting it out there, are relationship trades. And the Russell, for as weak as it has looked, it wasn't as bad as the NASDAQ here today. The NASDAQ had a full 100 basis points worse than the Russell. And I think about a year ago, maybe longer, but I ran the numbers on that spread. And I want to say that the average was maybe like 50 basis points, what you would expect on that spread widening out. So 100 basis points in a single day is a pretty decent underperformance by the NASDAQ. I don't know that I bet 2 days in a row, but just something to chew on. The VIX at 24.87 cash, up nearly $3 in VIX cash. VIX futures at 22.30. So let's take a quick look at VIX term structure, where we are for the day. We are solidly, my friends, in backwardation. We're solidly in backwardation. We'd flirted with this last week. We've sort of gotten flat. Cash has been above short-term VIX futures for a while, and you're now getting some of the short-term futures months, spiking. March is spiking, April spiking a little bit, and so is May in backwardation as well. The rest of the term structure is flat. And what's interesting about that is that's almost exactly when the cuts look to be starting. So, the market seems to be saying, and this may not have anything to do with it, just may be sort of a coincidence here, but May is when the implied cuts start. So if you take a look at how the market is pricing out meeting probabilities for the Fed, we've been looking at this almost every day. And one of the benefits of looking at it every day is you start to see the pattern. And if anything shifts, you sort of notice that shift. We had been noticing that the cuts had started in June. You got a second one in September, and the third one had just squeaked into December. Well, my friends, early this morning, prior to the open, Fed funds probabilities had shifted, and all of that had moved up a meeting. So the probabilities now favor a cut in May, not June. The probabilities now favor a second cut in July, not September. And there is no meeting in November, so the probabilities now favor a cut at the end of October, not in December. So everything shifted up by one meeting today in terms of Fed probabilities. Still 3 cuts, but they're moving nearer and nearer, my friends. I don't think that should really come as a surprise, because those of us that have been watching the curve, and the yield curve looks something like this, you can kind of get a look. You look at those short-term yields at the 1 year, the 2 year, and you kind of see what the market is anticipating the Fed funds rate to look like over, the next year or so. And they've dropped that to 4% versus where we are at 4.5%. So in order to get to a more normalized yield curve, you're looking to either at or below that level. And so there's your 75 basis points right there in order to get to a normalized yield curve. So where's that coming from? It's coming obviously from a lack of confidence in growth going forward. It's coming from poor economic data that I would argue. I would argue 2 things. One, I think the economic data has not been as good as it has been reported. Take that for whatever it's worth. We juiced up our economic performance with fiscal spending. And I think under the hood, the real economy was not as good as the economic data was reporting, given the juice. And I think we were, I don't know, a lot of the economic data just didn't, let me just say, it didn't seem right. And I think the weakness that is now being reported in some of the economic data, to me, is a more truer representation. That said, I do think the tariff stuff is spooking the hell out of people. I think if you're a business owner and you have no idea what the future holds, whether or not you're going to have a 25% tariff slapped on something, a 10% tariff, no tariff, some things you're going to get an exemption, there's a 30-day pause here. I think at some point you just go, I'm going to plan for the worst case scenario. And we'll, I would rather, as a business owner, be surprised to the upside than be surprised than plan for the best case scenario and be surprised that that doesn't materialize. I think the best of the business owners have probably already made a decision to mitigate as if worst case scenario manifests itself. And then they would rather be surprised to the upside. So I think that's probably what we're in the midst of. You know, growth estimates on the floor, inflation estimates. Look at the difference between February inflation expectations, and this is the Cleveland Fed inflation nowcast. February coming up here. So the report that will come up is the report for February. CPI 0.23% month over month. Whereas March, CPI 0.01%. Look at the drastic difference in inflation expectations anyway on a month over month basis, just 1 month out. So the growth expectations, the inflation expectations, clearly all of those things are telling a story that the bond market had already told you, right? And that's why we look at the yield curve every single day, because regardless of what your inflation number is showing you, which is really lagged by a month at minimum, and then that data is lagged by 3 to 6 months about what's happening in the real economy. You know, the markets are a discounting mechanism for 9 to 12 months in the future. They care little about what happened in the real economy 6 months ago. They're forecasting out, and I think what the yield curve is showing you has everything you need to know. They're not as concerned about inflation, at least right now, and they're certainly very concerned about growth. And I think the only little caveat to the story that I'm telling you right now is the 3-day sell-off in bonds. That long end of the yield curve is starting to tick higher, which I find really, really interesting. I mean, if you're on the long side of this trade, as I think Tom was this morning, I think you're happy to get 117 to 115 to be able to go long bonds even more. I think that's probably the right direction. But I argue, I'm very, very curious how much political pressure ends up coming at this administration. And if the first budget was, let's cut a bunch of social services, but also add $3.8 trillion to the deficit, that's budget number one, man. And we're going into a growth slowdown. What's budget number two look like? Even deeper cuts? Deeper cuts into that situation? Possible. But the political price they're going to pay will be heavy. And I'm just not sure that that's the direction they want to go. We shall see. Let me say what's up to you guys. Let me see what you guys are saying real quick before I go on to some of these other instruments. I need Bat yelling, "Pay me, B," as a ringtone or something. What's up, Victor? What's up, D-Chat? Let's see here. I just lost my place. Give me a second. How good your market skills are and how unrealistic your political views are. I'm down with you, CM. And by the way, I really do love debate, like good-spirited, respectful debate. That's why I'm here. That's why I get the opportunity to go back and forth with Tom and Tony and everybody, sometimes Chris and Ilya. If you haven't noticed, this show is a two-sided discussion. That's because that's kind of what I value. So it's all good. Just tell me what you think and why, and who knows, maybe change my mind or maybe give me the opportunity to defend my position a little bit more rigorously. You explain the push and pulls of the markets and the incentives of how it all works. Then you talk to your ideals, for which even you said were probably unrealistic, because those views were contradictory to the truth you mentioned about bonds, etc. Okay. I think that's fair. So my let me do this at the end. CM, let me come back to this. I don't want to lose the audience here, and I think more people are interested on what's happening in price action. So I'm going to come back to that at the end. I do appreciate the clarification. Take a quick screenshot, and I will come back to this and address it. I think it's a really good point. But let's keep cruising, baby. Priorities, Victor Jones. Get over with it already. Crash and stop rallying. End of day. It's frustrating, isn't it? It's frustrating. But the thing about it is, I don't think anyone's afraid. The interesting thing about where we are right now, when I talk to people, I don't think anyone is necessarily afraid. The weakness in the equities markets is being sold off, and Lutnick just said something. It's funny. I had this conversation with Tom. Tom called me a crazy person, But the premise was that the administration has a pain tolerance for the stock market that they probably didn't in the first administration. That was the premise. Now, online, people are talking about that this is all some big strategy to negotiate rates lower because of the $7 trillion in refinance debt that we have to pay. I don't know if it's that explicit. I honestly think that we're in a big poker game. And if it's that easy to figure out what your objective is, you're going to get smoked on the world stage. I think you have to have a big range of hands that the world has to think we're playing. And if the world just thinks we're playing this game for cheaper borrowing costs and it's all a big bluff so that we can refi $7 trillion and that we're not really going to do any of this stuff, it's not going to work. We're going to get our asses handed to us in this gigantic card game. So I think in reality, as much as we human beings want to be able to deduce things to simple narratives that then go, oh, okay, I understand what's happening, I do think the reality is much more complicated. I think there are multiple objectives and potential objectives. I think there are multiple planned outcomes. And I actually think what's even more interesting is I think there's a group of people that would like to believe that there is no strategy. I think there is a group of people, I think generally opposition feels that this is all just just a monkey pressing buttons. I hate to break it to you, but you might not think it's the right strategy. But if you feel like there's no strategy behind what's happening right now, you're probably just speaking with your emotions, not with your logic. That said, we talked about the incentive structure. I think Tom was on the complete opposite side of that. That was complete rubbish. That the president cares. I think the premise was the president cares about markets. The president always cares about the interest rate of and he had a really, really clean take on this, which is which president would you want to manage your money? And it was a total red herring argument, but he got me on that one. Anyways, the funny thing is the Commerce Secretary Lutnick comes out today and he says the exact same thing. Bessent has said it almost explicitly, and Trump, by right of not effing around with Jerome Powell, by not really talking to the idea of interest rates, because I think he knows if he does that, he's actually going to loosen up the long end of the curve. He's going to do the exact opposite. So he's shutting the F up when it comes to talking about interest rates, except for a few things he said early in his term. So I do think to an extent, at least borrowing costs are enough of a concern that Trump has changed his strategy to trying to jawbone short-term interest rates lower. Because right now I think it plays to his incentive structure. The second thing is I think Bessent does have a pain tolerance for this. And third, Howard Lutnick just said it today. I'm trying to think of the actual words he used. I probably should have had it pulled up, but something to the extent of that the stock market was not the stock market is not driving outcomes for this administration, is what he said. I mean, they're kind of telling you, again, that might be part of the whole like madman strategy, their chaos theory. It may be part of it, but I mean, you got to take it for a little bit of a discount. Anyway, my point is, because of that context, and because we're in this negotiation, and because I think people think, oh, tariffs are a negotiating tactic, and oh, they want lower rates, therefore they're going to take a little pain, but also we're gonna do what we always do. Like, I think everyone's discounting the potential that there's some fearful underlying realities here, but I don't think there's actual fear in the market right now. It doesn't seem that that's how we're trading. It doesn't seem that that's what the narrative is. And when I talk to people, it doesn't seem like there's any genuine fear out there either. You tell me if I'm wrong. Am I wrong? Russell's great for swing trading, but it has caps and floors. I agree with that, Sub-Zero. Weird thing about today is a lot of stuff was green. A lot of stuff was in materials. That's right, son. That's right. I'm telling you, one of these days, somebody's gonna turn on the show and go, oh, they were kind of talking that stuff over here. Here's the thing. I think in a world where we're actually moving forward with deglobalization, just imagine, okay? We're actually moving forward with deglobal. We're flirting with the idea of saying, we're not going to sell your liquor here, right? Or we're not going to take your agricultural products, or we're not going to take your steel or aluminum products. What does that mean? That means all the efficiencies of scale that we have from a global perspective are kind of gone. That means every country needs steel. Every country needs an input because we're all going to create duplicate economies. It doesn't necessarily mean we just find a bunch of, I mean, there's a reason why we're going after Greenland. And there's a reason why China's Belt and Road Initiative is trying to get so many inroads in with Africa. There's a reason why Ukraine, to a certain extent, is strategically important. And it's not, a deglobalized world means more demand for scarce resources. There's less growth, but we're all creating duplicate economies, and we're all doing that. We're all trying to build, gigantic data centers with godlike brains, and we're trying to switch to electricity and trying to control populations via sort of these new digital mechanisms. And I think, that's energy intensive, man. That's resource intensive. It's so clearly resource intensive, and we're duplicating that resource intensity right now. So I think at some level, to me, what's most interesting and what will continue to be, it's material stuff. I just bought Freeport McMoran, more of it today. I bought more Newmont today. I want to say somebody just screamed out, was it Kramer just screamed out how bad Albemarle was, which immediately made me look. I immediately looked at Albemarle, and I will likely be buying it tomorrow. And no offense, this is not like a Kramer. I'm not shitting on Kramer. I just think, again, it's the wrong concept. We are in a lithium glut, so it becomes real easy to look at Albemarle and see them on the floor and go, well, this is not good. But again, if you're a 39-year-old like me and you've got a decent time horizon and you're just going, do I think lithium as a resource, do I think its demand is going anywhere anytime soon? Do I think we're going to have that much of a shift in the direction of technology? See, probably not. Probably not. And to me, it's an interesting long-term bet. So I would fade the shit. I'd fade the shit out of that call. But I think those calls are sort of TV calls probably for the next 2 or 3 months, and that's not my time horizon here. I chased that, I was that dog, and I chased that car to me, it didn't have good outcomes. And here, I'm going to give you this one that I think I'm not saying I'm good at this, but I think to be good at this, you have to not care about being right in the eyes of the audience. I'm going to be honest with you. I don't do this to try to look good for you. And which is why I have no real issue eating a horrible idea. Oh, that did not work. Man, I got my ass handed to me. I don't mind that because my objective here is not to look right and to protect my professional reputation. There was a time when that was true. And you know what I said that was interesting? Exactly 0 things. When you're trying to protect your professional representation in this world, you don't say anything interesting. You don't say anything worth listening to. You don't say anything worth disagreeing with. You just want to be at the 50% line where this half isn't going to be mad, half isn't going to be mad, and they all think you're kind of smart. And when I start trading for my own personal performance, I give a shit whether or not I can put my kids through, really great private schools from preschool to university and beyond. I care about the generational opportunities that I create with my time here. That's what I care about. And so that's why it's more interesting for me to look at Albemarle when it's on its ass than to try to catch the momentum stock that I can be right in front of you for the next 4 or 5 days or 2 weeks or whatever. And I think thinking that way is probably going to put me in position to be in more interesting, longer-term trends than hot hands and trying to be right and wrong, stop, start. You guys be frustrated trying to follow somebody like that. You change your mind every 3 minutes. I'm not following you. Not that you should follow me. You shouldn't, but I'm not listening to you. Lone says, we need a juicy little flush down to scare the children a bit more. Again, I think so, but everybody thinks that way. Which means I don't know. That's a dangerous place because everybody's waiting to buy a dip. And when that happens, you don't get the dip because why would the market give you a discount that you were going to buy? Why wouldn't we just stay at the current price, which is where we would end up if I gave you the discount? I'll keep the riches for myself, then give it to you. That's the little sick thing of the marketplace. So you have to actually be fearful. The market actually think, in order to get to 36, you got to think its value is 35, which means you're scared at 36. I don't know why I'm saying 36, but like 56. You get what I'm saying? I just don't. There's no fear, which is so strange to me. Donna says, I think we sell off again tomorrow. VIX needs to be higher, and there needs to be more margin calls to end the sell. I would love to think this. You know what's weird? Here's the weirdest scenario. What all of us sort of think will happen is a 2-day flush, and all of you have a list of things that you want to buy. So you know what? So the worst possible thing that can happen is you keep getting 1% sell-offs, no flush, and you're paralyzed into thinking like, all right, it's lower, but I don't think they flushed. There's no capitulation, and they dog walk you down. They dog walk you down to 5,000, and you're like, what the hell? How do we get here? I was going to buy them at 56. I like how you conversed with Tom this morning. Let the president trade. That would be great. No, I mean, it was the issue I was taking. I know I'm all over it, but the issue I was taking wasn't that I thought the meme coin was a good thing. I thought for the life of me, can't figure out. And I try to give people the benefit of the doubt that I try to straw man their point of view. I tried to straw man that, and I couldn't understand why in God's name anyone would do that. To me, it's so much risk and so little opportunity upside because you can't take advantage of the upside. You own 80% of the market and this thing goes to the moon. The only thing you can do to liquidate is you rug pull everybody. And that would kill, it would kill your political reputation. with your own followers. It's just a bad setup. I don't get it. But my point wasn't that it was a good thing. My point was I felt the logic was inconsistent. You have no problem with Nancy Pelosi sitting on these oversight committees and also slanging short-term option contracts with her husband. But we do have a problem with the president issuing a meme coin. And if those two things, if one's on the side of right and one's on the side of wrong, explain to me exactly where that line was crossed. Because to me, that whole finding a line between those two things is going to be incredibly difficult. That was my point. Snap your fingers twice and twirl your hat, and we will be back at all-time highs. Yeah, I think that's. I wouldn't put that out of the cards. I think though Sub-Zero. I do think at some point, just like we kind of saw with Mexico today, I do think at some point these people are going to start making deals. You know, Mexico and the U.S. and the U.S. and Canada, and I've said this since the very beginning. I said this since the beginning that this is the first phase of a strategy, which is to get U.S. and Mexico to apply tariffs to China. And the reason they're doing it this way is because the first administration, they tried to apply tariffs to China, and they go, okay, I'll just set up a bunch of manufacturing plants in Mexico. And they worked their way around these tariffs, and they saw it. So this time around, they're trying to create a unified North America, who then has a bigger negotiating block and cannot be worked around to the same extent to again point that tariff gun in negotiations with China. And so it's a bit more methodical approach. I don't know if it's going to work, but clearly this was like a step one, and that's where we're headed. You know, if you get what would happen if you do get a full-on agreement between these North American partners, which it's as wild as it sounds, it seems like we're leaning in that direction. As tough as these guys talk, you can almost guarantee when Trudeau is talking tough, he's doing the opposite. It's like guaranteed. It's public strength, private weakness is the game with these people. But I think, like, what happens then? A little bit of risk premium comes out, but you still got to worry about growth, right? You still got, like, what happens now? A lot of the weakness in a lot of the forward guidance, that's all vibes right now, right? It is possible to turn this ship probably anytime soon. So I wouldn't put that out of the cards. I would say I sold a little bit of vol via the VIX future today. I think I'm probably too early. I would have liked to have done that closer to like 25, where VIX cash is. I don't love him. I don't love being short here at 22. I think we could easily see a spike up to 27. But I took a little stab. If suddenly everyone has a decent sense of what the plan is with trade, and that it can be reasonably expected not to change. I think you guys are going back and forth, which is we could easily be at highs, and CM is saying only if suddenly everyone has a decent sense of what the plan is with trade. I think that's true. And I think you don't get that clarity until you've made a bunch of trade deals. I think the point of the uncertainty, whether you like that or not, whether you think it's prudent or not, whether you think it's good governance or negotiation, the point of the uncertainty is negotiating leverage for these trade deals. Whether you like it or not, you've got to agree with me that that's what it is. Thank you for going over the VIX. Still wrapping my head around these levels. Here's the easiest way to think about the VIX right now, I think. The rule of 16. So what the rule of 16 tells you is every 16 points, If VIX is at 16, you divide it by 16. Why 16? Because there's, you don't need to know this next part. I'm just telling you in case you're curious. But there's 252 trading days in the year. So if you wanted, so volatility is an annual measure. And if you wanted its daily measure, you take the square root of time. So if you have 252 days, you take the square root of that in order to give yourself a number that you can figure out the daily percent move as implied by the VIX. So if the VIX was 16, the square root of 252 trading days is like 15 something something. So let's just use 16 as our rounded number. So the VIX is 16. We're going to divide it by 16. We get 1. That means if the VIX was 16, we would expect movements inside of 1% every 2 out of 3 days. Maybe 1 out of 3 days we'd see a movement outside of that. But generally speaking, 1% is sort of our maximum or outer band of realized volatility we would be expecting. Which then means about 24 is 1.5%. So if we take 24 divided by 16, we're going to get about 1.5. And so what the volatility index is effectively telling you right now, it's telling you many things, but really what it's telling you is that you should expect 2 out of every 3 days to be about 1.5%, the maximum moves. Maybe 1 out of every 3 days in the S&P, you're going to move slightly outside of 1.5%. And I think that's probably reasonable. Where we've been the last couple of days, it's about 1.5% moves. 100-point moves in the S&P is about 1.5%, a little bit more. And so you're basically seeing anywhere from 90 to 115 points on a lot of these days. So 24 VIX is reflecting the realized volatility that we've seen. So if you think on the horizon, and by the way, that's magnitude of move. If you got tomorrow a 2% move to the upside, it's possible vol wouldn't necessarily collapse because of that. Because again, the magnitude of that move, that's still a 2% move. 1.5% to the downside is still a 1.5% move, and a 2% move to the upside is still 2%. So the realized volatility is still above 1.5% in that case. So again, it's telling you, I think, on a daily basis what to expect, and I think we're pretty close, right? 1.5% moves are about what we're getting right now. And you just take that to say, do I think, I don't want to say that because that's not the way you guys think. What you guys think is vol is always overstated. But I do think at some level you have to have an assumption. And if you think a big washout is coming, you have to ask yourself, am I getting paid for the potential of a washout? And where would I feel comfortable getting tagged? In other words, what strike would I sell puts and know that I could get tagged on an outlier move to the downside if I want to sell puts? And am I getting paid the appropriate premium to do that? You got to make that choice for yourself. But yeah, I don't know. I digress here, but there's a couple of things that I always look at. The thing about vol, though, is Victoria, is it really is just helping you understand people's level of uncertainty and what they're doing with their distribution curves. Because we all have this sort of this model in our head of how certain we are about the future. And just the higher VIX goes, the more uncertain everybody is. And so the more range of possibilities they're allowing themselves to imagine and they're allowing themselves to price. And the smaller that number is, the more certain the market is about the future, and the smaller the range of possibilities they're allowing themselves to price. And VIX in backwardation, it simply means that what tends to happen because volatility is mean reverting is when you get vol spiking, you don't get the whole curve that's going to spike. Why? It's because generally volatility will spike. The market will either price or distribute the risk of what just happened, and vol comes down over time. So VIX backwardation is rare. So the short-term months spiking above longer-term months, that's called VIX backwardation. That is rare. I think it's happened 16 or 17. Let me say this again. Sorry. That is called VIX backwardation. It happens, and when it happens, it tends not to happen for very long. So there have only been 16 or 17 times since 2005 when we've seen this VIX backwardation for longer than 10 days. Typically when you see this happen, or I want to say typically, when it happens, you don't tend to see it stay in backwardation for a very long time. It can happen. 2008 was a case where it stayed in backwardation for, I think, 60-ish days. 2011 is a case where we stayed in backwardation for, I think, 70-something days. So all these are sort of signs and signals to how the market is thinking about vol and about elevated volatility. But it's not like it's going to give you some hard and fast signal on when to buy or when we're bottoming. All right, I'll move on here. I'll take a few more. Lobo says, Excel doesn't have a deglobalization function. Maybe a minute before folks can calculate new cash flows. Pretty scathing Wall Street Journal editorial just dropped about the tariffs. Yeah. Wall Street Journal. CM, the point about knowing things don't help trading is dumb. You don't know 100% what to do, but you know more than the rest of the market. I think so too, CM. I'm not gonna say it's dumb. I think half of the game, like, let's say you come into a poker game in the middle of the game. Okay, you buy in the middle of the game, and the game's been going on for 4 hours. The other people sitting at the table have been able to acquire a lot of information in the previous 4 hours. They've had a ton of reads on the other players that are sitting at the table. They've had beats. People flipped over the cards, tells, table talk. You've had 4 hours to acquire information about the game at that table. So the person who just sits down and knows nothing about the other players, nothing about the previous 4 hours of hands, that person still understands the probabilities of making their hand, right? They understand there's 13 more cards in the deck that can make my out, and on the turn, I've got a 30-something% chance of making my straight or whatever, or my flush, whatever. They know probabilistically they can hang with what's happening. But would it aid them to have understood the previous 4 hours of information? It couldn't hurt them. And that's, I think, how I think about the market, CM. That I think having more information about what's at play and what are the more moving pieces, I think it helps. But I do see his point that even with that, at the end of the day, it's still price. It still is something, cheap or not. And if you watch the market tick for tick for the last 30 years, you might not need to be so in the weeds about, this person saying this over here. Can you believe this Fed governor said that? I mean, you've probably seen that a million times. And at some point, it starts to look more like noise than signal. So I can see it from his perspective as well. I do think it might have more to do with experience than anything. The longer you do this, the more you know what to pay attention to and what not to pay attention to. I stopped reading all of the political commentary from the Wall Street Journal. I had a few friends that work there. I think they're great people, and they focus purely on the X's and O's. And then I something came out of that place, and I sent it over to this friend, and I go, "What the hell is this?" And they didn't say anything because they couldn't. And I think that silence said more. That silence said everything to me. So yeah, I take this stuff with a grain of salt. That's why I love the markets, because I don't need somebody to interpret the price for me. I think when I first started, I had to watch this news program and this news program and read this article and read this person. But now, to me, and Tom, this is one of the things Tom does is he goes, don't listen to anybody else. And it is true, man. Like, if you watch price, then you can figure out what you think is happening with those prices, and when and why you think they're cheap, or when and why you think they're expensive. Yeah. Just keep going. Every time I watch a show, I buy puts. I think that's what you said. Vic, I've been wanting to get your take on the tariffs and whether we just bounce around until we get clarification on dates and percentages. No, I don't think so. No, I don't think so. I think I think two things. One, I think it's likely that we do not end up at 25%. I think Trump's negotiating style, he puts out the worst case scenario and he walks it back. And so I think the likelihood that we end at like 10% or something like that is probably high. I don't know when, but that's what I would bet. I don't even know. Who knows? Maybe we land on 25. So I think the reality is we probably land somewhere else. 25 was probably the worst case scenario, and he started there. I think the intent, if I'm guessing, is to try to get them to agree to unified tariffs against China. And if we get there, then we probably meet in the middle, and they probably negotiate the acceptable retaliatory tariffs that Canada and Mexico can put back in the United States, and that's probably where we land. No, I don't think we just bounce, because I think then we start the next phase of this, which is now, if you have a unified North America, how does the next phase of more difficult negotiations go with China? And the second reason I don't think we just bounce around is because I think the market's trying to figure out. I think right now, the downside in the market into growth is vibes and surveys. The hard data is not great, but it's you could survive this, especially if you get an aggressive Fed cutting rates. But I think a lot of business owners, are just going to plan for the worst case scenario, and you're starting to see that in a lot of the guidance out of these companies. So no, I don't think we just bounce around, and I don't think the longer they kick the can on theoretical tariffs, the more they become already baked into the real economy. Because let's say you run a business and there's a theoretical tariff hanging over your head at 25%. What you'll do is you'll gear your business towards being able to handle a 25% tariff. So it means you find some efficiencies, you lay some people off probably, you either find some new suppliers, you change your supply chain, you maybe change your product, your output, the quality. You're going to do something ahead of time so that you're not just sitting there your business is beholden to some perfect outcome. And so the longer this tariff is kicked, the more business owners just choose to do that, which means they're already doing the thing that they would have if you would have just implemented the tariff in the beginning. People make the same argument for consumers. I don't know if consumers really care, right? I don't think consumers make a change until the price mechanism shifts. So if the businesses have shifted their prices as a response to the potential of a 25% tariff, then the consumer starts changing. But until the price mechanism shifts, I don't think the consumer actually changes. Yeah, so if you just keep kicking, that's why I said yesterday with Chris, if you just keep kicking the can and you keep hitting pause 30 days, or in this case, okay, we're going to give exemptions to any auto manufacturer that's under the USMCA agreement. You just keep doing that. It's not going to matter at some point. That was my point yesterday. It actually doesn't matter at some point because enough smart, savvy business owners are going to just act as if. And once they act as if, the price mechanism will display it. And once the price mechanism displays it, the consumer will change their behavior. And so whether or not you've put it on or not doesn't matter anymore because it's already being reflected in the economy. That was my point. When Tasty Trade started, I think vol was overstated. I've seen things on CNBC years ago talking about selling vol. So if tons of people are doing it, that would seem to lower it. This is sort of this CM. That's just really funny irony. And I brought this up to Tom once in one of those Thursday discussions. I said, you like to think of yourself as a contrarian, and you speak to a small but mighty version of retail traders, the ones who sort of the super savvy version of the world, but that group is small. It's not the majority of retail traders. I said, the funny thing, the two-sided sort of the knife that cuts two different ways about your point of view is if the whole world adopted your strategy, vol wouldn't be overstated anymore. It'd be closer to perfectly priced. And then you wouldn't get to do the things that you get to do at the price you get to do them at. And he sort of smiled and acknowledged the truth in what I was saying, that if everyone was a vol seller, that he wouldn't get juicy sort of overreactions in vol. And it would reflexively change perhaps how he thought about markets. So it's sort of a funny thing. I agree with you, CM. And he acknowledged it, just only in a sly smile. Surfer Boy, I don't know if that answers your question about my take on the tariffs. But I think the longer they're floated out there, and they've been floated out there at this point since prior to last November, right? The market starts giving the Trump administration a realistic probability of winning in October, knowing that tariffs are on the board. So I think to some extent this has been a potential for 5-6 months now in the eyes of the market. You guys are asking some good questions today. All right. The hot hand fallacy is the belief that someone who has had success will continue to be successful. It's a common misconception that can occur in sports investing. Yeah, man. I mean, that's what sort of television, that's the downside of financial television, because the hot hand fallacy or survivorship bias, right? That's how you get a Kathy Wood on TV talking up her strategy at what will inevitably be the peak. You know what I mean? That's how and why that occurs, is that we have this fascination with going, oh, you've been wildly successful. What are you doing? But you've been successful for like 2 or 3 years, which means you were doing something unique 3 years ago, and now it's successful only because other people are adopting it. So if you look at any adoption curve, it's the early adopters, right? Then sort of like it's the early adopters, and then it's, that second wave of people, I forget the name, and then it's sort of mainstream adoption into peak. And you can only be successful if other people have bought into your strategy or to your underlyings. And so that is why you're on television, because these other enough people have bought into the same concept. And at that point, you're sort of, the writing's on the wall that you're nearing sort of the peak in whatever you're doing. Soul Train says, hot hand fallacy does not exist. What I'm talking about is survivorship bias. I think hot hand fallacy sort of like, yeah, it's the same thing, I guess. It can be applied a different way, though. Ashy Larry. Vol is a display of fear. Everyone has a breaking point. I don't know. Jump Garson would argue with that VIX and Vol is not a fear index. Victor, how'd you end up in Australia? Not like there's anything wrong with it. I'm not in Australia. I'm in Singapore. My wife is Singaporean, and she really missed home. Yeah, she got real homesick, so we came back here. Do you believe an investor's edge is an inefficiency in the market that allows these people to have rapid overnight profits? I don't know if I understand the question, Zero. Do me a favor, dumb it down for me, explain it like I'm 5. Do you believe an investor's edge is an inefficiency in the market that allows these people to have rapid overnight profits? I don't think I follow the question 100%. I hear what you're saying, but I don't know if my understanding of the question is what you actually mean. So can you do me a favor and just rephrase that, and I'll do my best to answer it. Bonds again, that was a long time answering questions, but bonds again, not much doing here. What the funk? Yeah. As I said before, 3 days downside at 117. Every part of me wants to I said I was going to sell them at 120, and I have not. And at 3 points lower. And now I'm stuck. Gosh, Victor. Don't overthink it, man. That's what happens. Euro nearly 108. Insane. Absolutely insane. Shout out to everybody short dollars. That was the play. And shout out to Ilya Spivak, who correctly forecast that the currencies tied to cyclical behavior, cyclical economic behavior would underperform, the Aussie and the Canadian dollar being those examples. That dude sometimes is so sick in his calls and Forex. British pound and the euro just nasty moves to the upside, and Bitcoin at 90,200. I think I got lucky not to panic on that sell-off. I told you we bought some in that dump to 80. I think it was at 84. I bought a little bit and got lucky on that 10,000 point rally because of Donald Trump's Sunday night tweet. Tomorrow is going to be the U.S. Crypto Summit. So I will be curious to get details about what, if anything, any details exist about this U.S. strategic crypto reserve, which I am adamantly against. I wouldn't say adamantly. I am currently against, and no one has convinced me why this is a good idea. There's a bunch of Bitcoin people that can convince me why a Bitcoin reserve makes sense. And I don't know that I would argue that, other than to say that I think it sets the wrong incentive structure for the government. That Bitcoin is a reflection of fiscal mismanagement by the government, by our Congress, which created the opportunity or the necessity, depending on how you see the world, for Bitcoin. And so the idea of the very same government buying Bitcoin is like it's an infinite loop. It's a bad fiscal policy leads to excess liquidity, leads to the price of the instrument going up, which leads to the government wrongly thinking that they've made a good investment, which leads to them buying more and worse fiscal management. It's like this, it's this gross infinite loop we put ourselves in. Imagine a government who's touting the returns of the strategic Bitcoin reserve. How stupid that would be. You know what I mean? Does anyone understand what I'm saying? Like, imagine the crypto reserve of the United States, the Bitcoin reserve, is up, has some massive return. Imagine a future president getting in front of Congress and the American people in some future State of the Union and stating that as some like positive to the American people, knowing that you understand what, assuming you accept current assumptions about price and why it moves, and it's based on liquidity. Imagine an American people so dumbed down or so compromised because they own this stuff too that they believe that that's somehow a positive. It's just the infinite loop we get ourselves into if we start messing with this stuff is insane. But I don't know. Maybe I'm wrong. Tell me if I'm wrong. Ryan B says, 100% Victor, I hear you. Am I great? Does anyone else not see the infinite loop in this logic? Does anyone else not see it? I mean, if I'm wrong, please tweet me at Victor Jones. The O is in Jones is 0 because I like to be difficult, or send me an email, victor.jones@tastylive.com. I do not pretend or presume to have all the answers. I just use my own brain and critical thinking with the information I have to try to deduce my own point of view. And I don't get how this isn't an infinite loop. Anyways, we're going to get some more details on what that strategic crypto reserve is and any potential other announcements here for crypto. I'm guessing, of which there could be a few. But it has to be pretty juicy. I think the president probably took the headline out of that room with his tweet on Sunday. So I'm not really sure. Can you have any additional headlines that are upside or downside catalysts here? I'm guessing they're not. Can you guys hear me?
Yeah, we got you.
All right. Sorry about that. I had a little click and it went totally silent in my headphones. All right. So anyways, to the extent, like, do I think there's a possibility of event risk tomorrow? I do. Do I have a strong leaning one way or the other? I don't. But I'm going to stay tiny long here, only because I'm playing with house money. On the last little bit I have. BTC, Texas Reserve passed today, says Crazy House. What's up, Crazy House? Yeah, that one I don't understand. I got to think through that one. I got to think through that one a little bit. Individual states. God, man, what is happening? What is happening? I don't know. I mean, in that case, it's a different budget, and I think Texas. Do they have a surplus? They're not in a deficit. They're not deficit spending, are they? Let me see. Yeah, Texas has nearly $24 billion surplus and projected to have more than $28 billion in a rainy day fund. That's from CBS News on the 13th of January, 2025. So I don't know, man. Maybe I can make. Maybe I don't got a big. If you've got a surplus, and you don't have much control over the federal budget. Maybe I make a case for that, man. Good Lord. It's inevitable. The more you think about it, you know what I mean? The more you really think about what happens with Bitcoin, it's like it's inevitable. It's so inevitable. And you can be so against it. But like just game it out. Game it out far enough in your minds. Copper, for early part of the day, a lot of this stuff was doing terrific. Copper had a pretty decent early part of the day, sort of sold off a little bit towards the end of the day, and is now down after Globex close. But I went in here, I mentioned this earlier, I bought a little Freeport today. I like Freeport. I like to look for materials. If they're going to give me cheap prices on materials, I'm going to look for them. I do understand we're going into a growth slowdown. I understand it could get worse from here, especially if we materially violate 5,800. I think that's probably slightly more likely than going up and seeing new highs instantly. But the name of the game is trying to find things. In my personal opinion, the name of the game is trying to find valuable assets before everyone else finds them valuable. And I don't know that we stop finding precious metals. I think you buy up as many of this stuff as you can, critical minerals, precious metals, and you just wait. All right, I'll answer a few more and then we'll get out of here. There are a lot of miners in Texas, 20% of hours in Texas. Energy prices are negative. The miners will help stabilize the grid. I don't know. I don't want to talk. I don't know much about it. Sound dropped for maybe 5 seconds, but it's back now. Thank you. I knew it wasn't crazy. Gold at 2,900. It's hanging around, but we seem to be in this little sideways consolidation. 100 points between 28.50 and call it 29. Let's go 29.75. And probably 28.50 is the outlier. So let's go 28.75 to 29.75 is this little consolidation range we're in. I'll say I think you got to have stones of steel to buy into gold here. You're playing a momentum trade, and while I think it might work out for you, for me and my risk tolerance, I'd rather play the miners. I know I've said this before, and a lot of you have heard this before, but just in case there's a new viewer out there, I'm owner of both Newmont Mining. I think I own some silver as well, PAAS. I own a handful of these miners individually, but then I also own GDX and GDXJ. But I think a lot of the value, I think GDX and GDXJ, I don't think there's much of a discount there. That's just, to me, that's just as much of a momentum play as gold. So you're buying GDXJ, you're buying it at or near highs. You buy gold, you're buying it at or near highs. What I'm trying to do is I'm trying to buy the miner at a discount when gold is at the high. And the reason being, if gold takes a hit, my assumption is that the miner has already been discounted and will perform a little bit better to the downside relative to its peers. And on the upside, if people wake up, then it has a chance to outperform to the upside. So that's the premise of those trades. It's a relative performance trade. And you could probably structure it in a fancier, smarter way with going long one instrument, going short another, but I'm not getting cute. I'm just buying one thing. And I have a sort of a similar premise with XLV. In my personal opinion, like healthcare is a really interesting, I think it's still a really interesting theme. And I said that at the tail end of last year. It has done really, really well for the first part of this year. However, there are outliers to that move. So Moderna, Pfizer hasn't done really well. So the areas that seem to have done well, the areas with a large amount of, cancer drugs and cancer treatments in their pipelines or under patent protection currently. And, the other day, Moderna announced, what did they announce? It was, good gosh. So it had something to do with their cancer pipeline. I'll try to find it. Yeah. Moderna sees quite large revenue opportunity in cancer. Oh, so brutal. Almost makes you want to tear up a little bit. So I think, if you don't have great performance here and then you start announcing that you have an opportunity it's almost like being a tech company and not having AI exposure. You're going to start pivoting your business into where all the hot money is going, where all the investment is going, and you're going to start talking about AI. And it seems like that first shift was talking about the tremendous opportunity for this company in cancer, which seems to be where all the healthcare money is going right now. Take a guess as to why. And I think the stock was up 10% that day. And the narrative was because I think the CEO made some big insider buy. And I don't really think that had anything to do with it. I don't think that. Who the cares? I think it has more to do with them talking themselves into an area of the marketplace that probably has a lot more investment dollars floating around. But that's just me anyway. So I think Moderna and Pfizer are some of the more unloved instruments in healthcare. And eventually, and it might be the tail end of this healthcare rally, but eventually what can happen is you get a person who goes, I want healthcare and I've got an incremental dollar, and they go, Eli Lilly, now it's pretty expensive. Okay. Merck, expensive. Okay. Well, what do you got that's cheap? And then you see this relative value catch-up trade of some of the okay quality but underperforming stocks in a sector or in an industry. And I'm not saying that will happen. I'm saying the setup is there. That's all I'm saying. Let me see if you guys got any more questions. Otherwise, let's see. Costco missed earnings, sell gold. Let's see. They're down to what? $15? Not even. $14 and extended. You can't do damage to that company. Tom once said, it's a lot of Tom references this episode, but Tom once said, you would think they're selling, what did he say? You would think Costco's the one selling GPUs instead of steaks and, Kirkland butter. And I thought, if you look at the price, it's kind of a good point. Would you put Pfizer in in that underperforming healthcare group, Victor? I would say yes, less than Moderna. I would say less than Moderna. It's moved $1.50 since the start of the year. Maybe less than that. Maybe $1 since the beginning of the year. I guess the election, it's actually down for the year, but yeah, I would put it in that category. Sleepy Mocha, Tom Quote's my favorite. He's got some lines, bro. At Ryan B, I love Bat. Just think he got caught up with the simple-minded folks. Oh, no. Don't say that. Don't say that. I just think this will be the last thing I say, and then I'll come back to your original point, CM, and then we'll wrap. I think everybody votes their individual circumstances. And I think what happens is people judge other people. Like, let's say you have this political point of view, and it's informed by your personal circumstances. But I have a set of personal circumstances, and that those set of personal circumstances has led me to the opposite political point of view. Well, I'm going to judge your point of view by my personal circumstances. I'm going to make the assumption that you've seen everything that I've seen, that you've endured everything that I've endured, that you've had that same experience and point of view, and therefore I'm going to judge your political point of view by my context. And I think that's where most people go wrong. That person grew up in a different neighborhood with a different set of circumstances. In everyone, even though some people like to think that they have a political opinion because it's a better thing for other people, but the reality is everyone makes a decision based on their own self-interest or what they believe to be their own self-interest, which may include other people's self-interest. But so I just think the mistake that people make is judging other people's opinion by their own context, you know? I mean, that's not just political. That's almost all things. So I'll go back to your first point, CM, that you made at the beginning, which was a critique on my some of the points of views that I shared yesterday. And I'm appreciative of all feedback and opinions, critique or otherwise. So this is not me coming at you. It's just me responding to, I think, fair criticism. So just for the context for everybody else. All right, let's do this. So yesterday I shared some views, what I thought, the way I thought about markets, the way I thought about some political positions, not many, but just generally that purchasing power, I think most problems stem back to purchasing power and money in politics, the incentive structure of money in politics. So I think the center of a lot of our problems can be unraveled if we all collectively understand purchasing power and how the decisions that we make at a governmental level and at individual consumer level, how it impacts purchasing power. And then the second is Citizens United decision, which I think is has a clear and direct impact onto the incentive structure. So anyways, the purchasing power aspect of my political opinion means that I would knowingly endure pain in order to, I think, right the ship in some aspects of government and misallocation of capital in order to get to a better future world, right? There's probably 5, 10, who knows, maybe even more time than that. We've racked up this bill, and if we want to get to some sense of normalcy in a more competitive economy, we would have to go through a period of pain. And I'm not saying that this administration is delivering that. I'm not saying that there is a candidate that delivers that. My political point of view is informed by my views. It's not informed by somebody else that ran for president that now I'm going to download all their views as my own. That's not the way I operate. I have a set of opinions on the world, and the person that comes closest to representing my opinions or my value set is the direction that I go. That said, some of my opinions means that we would have to take some pain, and I don't think we're structured for that. In other words, the incentive structure of a politician is to get reelected, and who the hell is going to get elected just to steer us in a direction where we would manufacture a recession? You're not going to get reelected. It goes against your own personal self-interest and incentive structure. And by that measure, you could call what some of my opinions is unrealistic. However, here's my argument against that, CM. And it actually came, Bernie Sanders gave an interview once with a podcaster named Theo Vaughn. And one of the things that Bernie Sanders was explaining was the incentive structure in politics. And he said, look, if a politician gets elected and he wants to keep his seat. If he goes against a certain position, then perhaps he used an example, right? But let's say AIPAC. If you have a position that's sympathetic in Gaza, or maybe it's a bit critical of Israel, then the AIPAC lobby comes after you. You lose your seat. And I remember thinking, when he said that, I don't remember if AIPAC was part of this. I don't want to make this Israel discussion, but like it was just like I'm using it as an example. I think he used some example. I can't remember what it is offhand. But I remember thinking, oh, bro, like I think you think that was a valid reason to vote against the interests of the American people. What you're saying is, hey, look, I don't want to do this, or the politicians don't want to do this, but if we don't do that, we lose our job. And I thought, man, what a cop-out. What a cop-out answer. And there's been few times in my life where I wanted to be able to transport myself somewhere and be on the other end and to ask the follow-up question. It happens rarely. I think most people do a great job interviewing, but I wanted, right at that moment, I wanted to ask, well, why isn't the purpose of a government employee to serve the people and the will of the people? So if you're telling me you're choosing not to serve the will of the people for your own personal self-interest, you're part of the problem. And if we all collectively, all public servants, decided that they weren't going to be intimidated by these types of tactics, then we can continue to elect new people who would do the same exact thing when they got there. We could nullify these tactics if we chose to continue to operate. And this is same idea. So if he values the idea of a union, well, they collectively bargain. What would it matter if it was Bernie Sanders or Joe Schmo that we vote in the next time? Because the voters continue to operate the same way. And so it's this cognitive dissonance that you argue for collective bargaining, that you argue for the people moving in one direction, but then when it comes to you and your own political self-interest, it's, well, I can't do that. I want to, but come on, there's so much political pressure, they'll just organize against me and vote me out. But if we all act in our personal self-interest, a strike wouldn't work because everyone would cross the picket line and then the strike would be broken. We wouldn't be able to collectively bargain. The cognitive dissonance in that answer infuriated me. And so do I think it's possible that we elect government servants that serve the will of the people? Is that unrealistic, CM? Maybe it is to you. Maybe it is. But I would like to believe, as romantic or poetic as it is, that that's what we're supposed to be doing in the first place. And the fact that that isn't the case is the anomaly. That we took a turn somewhere. And the fact that we don't have term limits, the fact that people want to have a lifetime in government then creates the incentive structure to want to get reelected. But if I can only go 2 terms and I got my first term and maybe I don't get my second, I got to go back and face these people and I got to get new jobs and I got to shake hands. People, like what this used to be is you serve time in the business community or you serve time in the military, and at the tail end of your career you go into government to serve the people. And now you're just trying to hold a seat forever and you'll take any opinion to stay there. To me, that can be resolved. You put in term limits, you overturn Citizens United decision. And I don't think what I'm talking about is that unrealistic. I think under the current incentive structures, it is. But if I'm going to accept the premise of everything somebody gives me, bro, like there's no resistance in a world where you're going to accept everything that somebody's given you. There's like a revolution wouldn't exist. I'm not calling for revolution. I'm just telling you, like, resistance comes from the lack of acceptance of pre-existing conditions. So to your point, you said at the beginning of the show, you explained the push and pulls of the markets and the incentives of how it all works. Then you talked about your ideals, which even you said were probably unrealistic because those views were contradictory to the truth you mentioned about bonds. So what I'm saying is, In order to get to the world where the policies that I support are possible, we have to somehow fix a few of the incentive structures. And so I think at some point, when people get tired of banging their heads against the wall and voting for a red or blue candidate and realizing they're going to get the same outcomes, then perhaps people turn their attention and they focus on Citizens United and you get a movement there. It's not today, but maybe it's tomorrow. And when people get tired of these career politicians making these backroom deals and guiding policies against the will of the people, maybe they go, you know what? The incentive structure of lifetime in government is bad. Maybe there's a movement behind term limits. And I think with those two things, man, what I'm talking about is not unrealistic. And I don't know that we're there yet, but the pendulum swings. It swings far and fast. So give it time. CM, you're a good friend. You're a good person. I appreciate the challenge and the critique, and I welcome even more so. You may email me, anybody, victor.jones@tastylive.com and @VictorJones on Twitter. The Owen Jones is 0 because I like to be difficult. I'll see you back here next week. This is Synthetic Friday for us. Best of luck tomorrow, man. You've got to close below that 5,800 level. So it's do or die time tomorrow. It's time to figure out where this thing should. Time to figure out what price this thing should be trading at in the equity markets. So Godspeed out there. Good luck. I'll see you back here next week. Until then, peace.